Good afternoon, everyone. In today's video, we're going to continue again on the same theme of using market internals data, specifically in the form of the Cumulative TICK Pro indicator, to essentially try and find trade ideas. Now, there's two specific trades that we'll talk about in today's video. The first is a trade that's set up today in the morning. This was based off of our 7 a.m. likely trending up move. I'll talk about the vertical spread that I set up there along with the results of that. And then the second is a trade for tomorrow based off of the closing results of the SPY today. Now, keep in mind the frequency in which we've been seeing these opportunities, at least the end of the day trades, is I think a little unusual. We don't typically see as many as we've seen. I think we set one up on Thursday as well, which led to a 100% SPY winner. Now, again, we got the same signal today, so I'll talk about where I'm looking for at least a SPY to go tomorrow. Now, let's start first with the trending up move that we saw in the morning. So this was our likely trending up. We've signaled this to be at 7 a.m. Pacific, and this was via a 1-minute chart. So the trade that actually ended up setting itself up was in the SPY. I'll talk about the exact spread. Actually, let's detail the spread first. So that was a 336 spread that I ended up purchasing for 18 cents, and I'll talk about exactly where that was along with what the results were. So keep in mind this is an out-of-the-money call vertical debit spread, and it's priced in the sense at least that it's a low probability trade, right? 18 cents trying to make a max total of 82, which of course usually doesn't happen, right? So the risk was 18, max reward was 82. Now this entry for me came in this second pullback, so let's first talk about the entire anatomy of the trade. Now, we had the signal at 7 a.m. Pacific. From that point, we had a gap up higher in the S&P, right, based off of Friday's close versus today's open. Then we had a pullback to the market pulse, and we even had one rally after we first saw the signal. Now, in this rally, this wasn't the place in which I got filled. Really just saw this move taking place while I was still waiting for the signal to happen on a 5-minute chart, which, by the way, never came. Now, off of that 1-minute chart, we had another opportunity to re-enter where after hitting that 1272 extension of this swing high to this swing low, we then had a pullback all the way to our 50% retracement zone. And at this point is where that spread was entered for a debit of 18 cents, I believe it was, in terms of the fill. Now, I've noticed when you're doing these out-of-the-money call debit spreads or even a put debit spread, the sweet spot I found to be is anywhere between 15 to 20 cents. So you're essentially risking 15 or 20 bucks to try and make either 85 or $80, all right, based off of whatever you get filled. If you can get in between the 10 to 15 cents, I think that makes for a really nice risk reward where you've quote unquote gotten a good deal, but that doesn't really happen too often. For example, on the second batch of scaling in contracts, if you want to call it that way, I was trying to bid 10 cents, never got filled there. So keep in mind that's a trade-off that I think you'd have to live with, but 15 to 20 cents, nice sweet spot. So now we take a look to see what happened here. We then started to see the S&P continue to grind up higher. The reason why I chose the 335, 336 actually before we continue is we had already hit the 1272 extension, then pulled back. And to me, the next target, if we were to break, was essentially a break above our previous high right here, and then targeting what I thought was the next quote unquote sweet spot here, which was the 335 zone, right? You take a look, the 618 was at 334.90, you had 335 there, and 335, 336, and ended up being the next spot that I thought we would trend up into. Now, coming back to what essentially ended up happening, so from this point, the S&P continues to grind up higher. Now, keep in mind, this was a very much of a grind type move, in which I would almost argue that the spread that I got, the debit spread, may not have been the smartest, and a vertical credit spread may have been even smarter, and in the money, slightly deeper in the money credit spread, in which you're again looking for a break-even price above the 618 zone. I think that would have probably been a better way to try and play this, but the debit spread is one that I got filled on. Now take a look to see what happened here. Essentially, you had the S&P go up, then fall just a bit short of the previous highs along with that 1272 extension, and again pull back this time to the 618. So what do you have here? You do have higher highs. However, you still have really just choppy action that for the most part was really just a whole lot of sideways if you kind of take a zoomed out approach here. Now, from this point, after we really had that lunchtime hour end on the East Coast, so that's 9 to 10 a.m. Pacific, that's when you see the S&P really then starts to take off. And if I keep going forward here, you'll see we essentially slammed right into that 618 extension. Now let's discuss the sort of heat and the reward that we had to deal with on the trade. So this 18 cents went, I believe, all the way down to something like 14. That was about the max heat that I think I felt on this trade. And in terms of the reward, at that 1618 extension, this was then sold for 35 cents, which again, you could program as an automated trade if you'd like, or just set an alert, whatever you'd like. But once we hit the 618 extension, I was able to get out for 35 cents. I think it bid even a little bit higher. I think it went up to something like 38, 40 cents. So I didn't get the absolute best closing price, but the 618 right here, when we touched it, that was where I exited for 35 cents. Then let's take a look to see what actually ends up happening, where the S&P from that point continues to fall. right? So that 618 extension ended up giving you a nice place in terms of targeting a move. 335, 336 was a very affordable way to try and play this trade. I was in 18-cent debit. Again, that 15 to 20 cent zone I found to be a nice area. And then into the close here, we saw the ticks continue to rise, where into the final close of the day, we saw we had our likely trend exhaustion move. And this is very similar to what we had last Thursday when we set up that trade for Friday, which ended up being a really nice 100% winner. So now, knowing that we ended the day with a likely trend exhaustion move, let's zoom out here, come back to our daily chart, and see what kind of trades we can set up for tomorrow. Now, if I remove this extension, the cleanest, I think, most obvious trade that stands out to me is looking for a gap fill based off of that trend exhaustion really notification that we got. Now, that gap fill takes us really to the high of this previous candle, which if we take a look at that, the high of that was 329.58. And if we round that up, that takes you to 330. Now, if we come into our trade tab here, let's try and set up some 330 spreads for tomorrow. So obviously the 0 days to expiration is gone. Now, the next expiration cycle that we have is the 2 days to expiration series. We said we'd like to target the 330 zone. So really the spread then at just a dollar-wide spread for those that don't really want to risk a whole lot, that makes sense to me is at 330, 329. Let's try and price that out. So currently that's going for, again, 19 cents, fits inside of that 15 to 20 cent zone. In the morning, what I expect to really see happen if we map this out, wouldn't be all that surprised if we end up actually having a slight move up. This is exactly what happened on Friday, except on an inverse scale, where we just rally very slightly in the morning, and then from that point, continue to fall for the rest of the day. That to me seems like the likely scenario. Now, of course, keep in mind that doesn't have to happen, and it just happened on Friday. That's the only reason why I say that I think it would happen again. For our members, in terms of the signal that I would be looking at, if you come into a 5-minute chart here, I'd be looking for a bearish edge signal arrow after we get that morning signal. So that bearish signal looks something like this, except we want to see this earlier in the morning. So if we revisit Friday, in Friday's case, this was our signal to get long based off of the inverse trade. We'd this time be looking for an opportunity to get short, where you'd want to see this red arrow again in the morning hours. So that would be the trigger signal in terms of entering this trade. Now, outside of just this buy, I think some other opportunities would be focusing on short opportunities via the stock volatility box. To give you an example of what that looks like, so these are going to be trades that hit the live scanner, and we're going to be looking for a short opportunity. So actually, let me go ahead and load in our volatility box for true. So now to give you an idea of what that short looks like, keep in mind this happened later in the day, so we'd want to see this essentially happen much, much earlier in the morning, which again lets you set yourself up for any sort of moves in which you're filling the gap from today's gap up higher. But that's a trade that looks very similar to this. So if I come into a 1-minute chart here instead of a 5-minute chart, so now coming into that 1-minute chart here, the stock would hit our live scanner as soon as we breach this volatility box cloud. And in this case, for example, we had price action breach our volatility box cloud. You'll have a list of all the stocks. I would focus on aggressive and conservative shorts for tomorrow in the morning. Then we'd be looking for an edge signal confirmation. That's this red arrow off of a 1-minute chart. That's more aggressive, but I think that's perfectly valid. I put a bias towards stocks that have liquid options. That would be, I think, a preference as opposed to shorting the actual shares. But if you don't mind shorting the shares, then that gives you another opportunity to participate with a different sort of asset class. But I think options here give you a better risk to reward, along with a better way to try and manage your risk buying a put here. And once we see that edge signal arrow, as long as we get an entry at the clouds or better, that then is our signal to try and play the reversal moves. Now, what I'm hoping we see tomorrow, if I map this out using true, and again, we want to see this much earlier in the day. So what I would hope to see is essentially in the morning, we have a series of stocks that rallies into our scanner right here, populates on the scanner as aggressive conservative shorts, really has been hitting the cloud, chopped around sideways here just for a little bit, giving you an opportunity to enter. And then from that point for the rest of the day, we really see a drift move down lower in not only the S&P, but also these particular stocks, which are then giving you an opportunity to enter at the edge. So that to me is the game plan for the stock volatility box. And don't expect that we would necessarily breach the scalper short lines for our futures members, but I do think that, again, using the cumulative tick edge signals there gives you a way to participate in that using the SPY options, the Q options, the DIA options, whatever you prefer, right? Or even the micros if that's your choice. But that really is how I'm looking to try and trade tomorrow based off of that trend exhaustion move. All right, hope this video helps in terms of creating a game plan for tomorrow in which you can take the information that we have based off of the data analysis and use that to try and at least trade some of these moves either via stock, either via futures, or via the underlying ETF options. Take care, everyone. Good luck trading, and we'll see you in the next update.